My name is Kelly DuPont, and I'm a managing director with Probitas Partners. And I'm here with Peter Cornelius, who's a managing director with AlpInvest and the head of research and economics there. You've done some look at risk management with private equity. In an inefficient asset class, which is illiquid, how does one really go about looking at portfolio management over the life of the investments?
Well, the first point I would make is investors in private equity funds expect an illiquidity premium. And an illiquidity premium inevitably comes with increased risk. So risk needs to be managed very carefully. And the first point is to recognize there are different types of risk. The first one is liquidity risk. First of all, you cannot rebalance your portfolio easily. Second is funding risk. You need to be in the position to respond to capital calls at any given point in time. And I think that is something which has challenged a number of limited partners. The secondary market, although it has grown very significantly and it has helped limited partners manage their funding risk, is not enough. Limited partners need to undertake a funding test in order to make sure that they can respond to capital calls at any given point in time. Second, in addition to liquidity risk, we need to manage market risk very carefully, as well as capital risk. And here, the new EFCA guidelines that were released earlier this year suggest that limited partners conduct periodically a value at risk analysis of their entire portfolios. So to summarize, there are different types of risk and they all need to be managed on the basis of different risk management tools, through funding tests, through value at risk tests, and so on. Those have been laid out in the EFCA guidelines released earlier this year.
In times of market stress, one of the things that happens to secondary prices in the markets is that the bid-ask spreads or the discount to net asset value tends to increase. When you're looking at these risks over time, does that make things harder for you? You can use secondaries as a tool to help manage risk to a degree, but when the market is under pressure, the amount that you'll get back from that process of using secondaries tends to decline.
Absolutely. So the secondary market clearly is a very substantial improvement in terms of risk management. However, it is not a tool limited partners can entirely rely upon. So in terms of managing their funding risk, many limited partners rely, first of all, on the distributions, and those are predictable under normal market circumstances. Second, they can sell assets. Third, they can borrow in the capital markets, and we have all seen this in the last financial crisis. But finally, of course, they can sell assets, primary fund stakes in the secondary market. The problem with that, however, is that liquidity tends to go away precisely at the moment when limited partners need it most. During the last financial crisis, the volume in the secondary market dropped by 50%, and we had discounts of up to 60%. So that shows you how important it is not to rely exclusively on the secondary market, but to conduct funding tests at any given point in time during the cycle.
When you're looking to build a portfolio, which you may be stuck with more or less if you have a market crisis, unlike other areas, is this an area where you really want to take a look at building a portfolio across different sectors? You know, for example, buyouts, mezzanine, venture capital, or is it an area that geographic diversity really helps you? Or is this really a market more heavily drawn by the fundamental performance of the underlying managers, since there tends to be a wide dispersion of returns between funds?
I think our work shows that it's a combination of all of the above. You want to be diversified across different market segments, but it really starts with determining your strategy. How much do you want to allocate to primary fund investments as opposed to secondaries and co-investments? So that's the first dimension of diversification. Second, different market segment in terms of venture capital, in terms of buyouts, distressed mezzanine. Those are not 100% correlated, they follow different market cycles. Third, different geographies. We have seen the emergence of non-traditional markets over the last few years. Again, those do not fully follow the cycles we see in the more traditional markets. And then finally, and perhaps most importantly, diversification over time.
Right.
Vintage year diversification is absolutely critical in our view. Now combine this with management selection, which is critically important too. So this gives you 5 dimensions of diversification. And I think that is very, very important to look at in order to avoid any excessive concentration in your portfolio.
Great. Well, thank you very much for your views.
Thank you.